Late last week, the idea of a 50-year mortgage was not so subtly floated to the American public. Now, almost everybody immediately called this out for being a really dumb idea, and for a good reason. 50-year mortgages will effectively double the total interest people pay on their homes, they will undermine equity accumulation, it will make the housing market more rigid than it already is, introduce significant structural risks to the financial system. Oh, and this whole thing will just make homes more expensive than they already are. The average first-time homebuyer is now 40 years old. Adding on a 50-year mortgage at that age means that statistically, people will still be making their payments 11 years after they are dead. This is not to mention that if we still really thought it was worth trying, other countries have already done that for us, and the results were pretty disastrous. Now, you probably already knew all of these issues, but the problems that come with a 50-year mortgage go much, much deeper than this, and this raises two important questions. If 50-year mortgages are such a threat to our economic system, then how exactly did we decide that 30 years was the ideal? But perhaps the more important question is, if this is so obviously a dumb idea, who stands to profit the most by making it happen?
According to a new report, the impact of rising interest rates on new mortgages has put home ownership beyond the reach for many.
Need to be earning an extra $17,500 this year to afford a home just compared to last year.
In an attempt to make home buying more affordable, President Trump floated this idea of a 50-year mortgage.
That's a lot more interest but lower monthly payments. What do you think?
Girl, bye.
Okay, so we have to get the obvious stuff out of the way first. And the biggest issue of all is that 50-year mortgages won't make homes more affordable. In fact, they will probably do the opposite. In a perfect world, being able to spread your payments out over an extra 20 years should lower your monthly payment. But even with the optimistic numbers, the difference would not be nearly as large as you might expect. Assuming a very competitive 6% interest rate on a $320,000 loan used to buy a $400,000 house, your monthly payment on a 30-year mortgage would be $1,919. If, however, you could spread that out over 50 years, then your monthly payments would fall to $1,685, a savings of $235 a month, which is not that much for almost doubling the total loan term and the amount of interest you will pay over the life of the loan. Most people have just pointed to this simple arithmetic and written the whole thing off as a big waste of time. But, to play devil's advocate and give this the best possible chance of making some sense, some people will try to make the argument first that if you take those monthly savings and invest them into the stock market, your returns could be higher than your interest payments, letting you profit off the difference and putting you in a better financial situation later in life. Right now, less wealthy households overwhelmingly have their wealth tied up in their home. Of course, poorer households are less likely to own their own home, but they are even less likely to own a significant amount of financial assets. If people actually took these monthly savings and invested them diligently into the stock market, then not only could it theoretically improve the balance of wealth amongst lower income households, it could also make it easier for first-time buyers to get into the market in the first place. $235 a month invested over 50 years could be $3.7 million assuming historic market rates of return, which is over 10 times more than the additional interest a borrower would pay on their 50-year mortgage. However, that is if absolutely everything went perfectly. And I already know what all of you live streamers are saying to your chatters right this very second. Almost nobody taking out a 50-year mortgage is going to have this level of financial discipline. The reason I even bothered with the devil's advocate shtick at all is because if these financial products do come to market, this is exactly how they are going to be sold to people. You aren't signing yourself up for multi-generational debt. You are arbitraging the time value of money. Optimistically, people are just going to take the money that would have gone to repayments and use it to cover other areas of their household budget. Now this is optimistic because at least a bit of extra spending might contribute to economic activity. Realistically, all this is going to do is increase house prices by stimulating demand just like it has every single other time we have tried this. In just last week's video, we saw how longer and looser auto financing has made cars more expensive. The only reason why college kids with no income can pay for tuition that has outpaced inflation by 400% is because it's become so easy to take out student debt. More recently, everyday items have been allowed to inflate further than they might have otherwise been able to, with a little help from all kinds of weird and wonderful consumer credit. And yeah, even 50-year mortgages were introduced in Japan in the 1980s to assist with housing affordability. All it did was make real estate even more expensive, contributing to their record housing bubble. But that's fine, because it all ended super well for them, and their economy has been thriving ever since. So yeah, we may not like to admit it, but we have probably dug ourselves into the same kind of hole. For now, if we actually genuinely just wanted to make homes more affordable for first-time homebuyers, 15-year mortgages would probably do more good than 50-year mortgages in the long term, but more on that later. As for the benefits to first-time homebuyers, this is also ignoring the other costs that come with owning a home like property taxes, maintenance, and insurance, which means the total month-to-month savings will be even more marginal than even the optimistic estimates would suggest. It's also conveniently ignoring the fact that longer loans will probably attract higher interest rates from lenders, effectively eliminating the month-to-month savings for most people. From the numbers alone, this looks like a bad idea on top of a bad idea on top of a bad idea. And to be fair, most policymakers have acknowledged this and tried to distance themselves from this plan. But there are still two big reasons why we might end up seeing these loans anyway. They are going to make a lot of money for the right people, and we may be out of other options. So it's time to learn how money works to find out how you are going to be left holding the bag on these mortgages, even if you never use them. I spend a lot of time researching, organizing, and planning our videos for each month. So anything that helps us move faster from idea to finished video makes a real difference. Which is why I partnered with Comet by Perplexity, a new browser that's built to help do things for you to make your life more productive rather than just search. Comet introduces these background agents that act as your digital assistants to take actions for you, like booking something, organizing your schedule, messaging people, or pulling together research, all from inside your browser. It's like your own digital assistant, seamlessly built into a way you already browse. What I hate the most is getting bombarded with ads. Comet comes with an inbuilt ad blocker. No ads when you browse online. And when you see that little blue halo, that's your Comet agent in action, literally working for you in real time. I've been using it to help organize my notes and research for upcoming projects, and it's honestly made the whole process feel less overwhelming. Instead of juggling a bunch of tabs and apps, Comet just helps me stay focused and finish things faster. Comet is built for you, whether you're a professional, a student studying for an exam, or researching for a paper, and a creator like me. So if you want to give it a try, download the Comet browser for free using the link below. Alright, so behind most bad ideas is either a profit motive or some level of desperation, and you don't need to tighten the tinfoil hats too tightly to see both of those elements here. The current proposal to introduce 50-year mortgages came from a meeting between the president and the Federal Housing Finance Agency director, Bill Pulte. The FHFA was established in 2008 after the global financial crisis to keep a tighter leash on Fannie Mae and Freddie Mac, the semi-government enterprises tasked with buying up mortgages off regular banks provided they meet strict criteria regarding lending standards. Theoretically, you could walk into your local Wells Fargo today and ask for a 50-year mortgage, and as a private business, there is nothing specifically stopping them legally. However, at the moment, these loans are extremely rare for two reasons. The first is that 50-year mortgages do not currently fit within the underwriting criteria of Fannie or Freddie Mac. So if the bank gives that loan, they can't sell it off to these organizations, and instead they have to keep it on their books for the next 50 years. Compared to a regular 30-year mortgage, which they can make a quick, easy profit on overnight, this kind of deal just doesn't make business sense, except for maybe rare instances of extremely large loans to private banking clients. However, if the Federal Housing Finance Agency instructed Fannie and Freddie to start accepting 50-year loans as well, then that would be the first barrier removed. The second reason why private banks don't do this for now is because 50-year terms are outside the bounds of what the Consumer Finance Protection Bureau considers a qualified mortgage. Qualified mortgages just means that banks meet some basic requirements to satisfy the Bureau that their lending is not predatory. If they do meet these criteria, they are offered legal safe harbor, which makes the banks harder to sue if the mortgage goes tits up. For now, loan terms beyond 30 years do not meet these criteria, which means if you get given a 50-year mortgage and end up in financial hardship, you could theoretically take your bank to court for predatory lending and they would have far fewer legal protections. Now, they would still have an army of lawyers, so please don't try it just because someone on the internet said it was theoretically possible. Anyway, this might not matter soon because the government is currently pushing to dismantle the Consumer Finance Protection Bureau anyway by cutting off its funding. This would remove the last barrier to 50-year loan terms, and if banks are allowed to write these loans, there is a big incentive to do so. Longer loan terms are more valuable when they are turned into mortgage-backed securities because they pay interest for an additional 20 years. Longer loan terms will most likely also enable slightly larger loans, maximizing bank revenue. Now remember, the Federal Housing Finance Agency back up here was specifically created after the subprime mortgage crisis to try and stop the whole system from getting too crazy again. So then why would they be pushing for riskier loans that are going to make the market more unstable? Well, we may never know. But on a completely unrelated note, the current director of the FHFA, Bill Pulte, is one of the heirs to the Pulte Group, the third largest real estate development company in America. He is also the founder of Pulte Capital Partners, a separate private equity firm he started in 2011, which according to their website makes focused investments into construction-focused businesses like roofers, HVAC installers, and drywallers. That means both the family business and the private equity firm are reliant on people buying and selling homes to generate returns. And that's a problem because home sales have cratered since interest rates have risen. New buyers can't afford to break into the market, and existing homeowners don't want to sell their homes after they locked in low interest rates. Now, if 50-year mortgages become commonplace, they would only make our current predicament significantly worse for future generations down the road. If people can lock in good rates for 30 years, that can cause problems. But eventually, they build up equity, and for the final 15 years of their loan, their nominal interest rate is not as big of a deal. However, if people lock in a 50-year mortgage at a good interest rate, they will build up equity in their home far more slowly, which means that the current rigidity of the market could be extended for the length of an entire generation. However, that will be a problem for a generation that isn't even born yet. And obviously, it should go without saying, screw those guys. We have problems to fix right now. Today, even those households that were lucky enough to lock in low interest rates on normal terms are starting to struggle. The true extent of financial hardship in the housing market has become incredibly hard to track because of a trend that is being dubbed extend and pretend. Basically, lenders have allowed borrowers to defer or renegotiate their payment schedules quietly behind the scenes without officially noting them down as delinquent payments. They extend their loan terms and pretend everything is okay. Now, for the lenders, it could be argued that some repayments are better than no repayments, but for the financial system as a whole, we truly don't have reliable data on how dire our situation is. For home builders and financiers, this is a real problem. But one way to get things moving again would be to make financing terms even more flexible. A 50-year loan is effectively just officially sanctioned market-wide extend and pretend. This could be sold as helping out new buyers break into the market, but the people who it will help the most are existing investors. One of the biggest problems with real estate around the world is that modern homes have become assets first, with a side hustle in accommodating humans as a distant second priority. This is because they are one of, if not the single most effective vessels for finance and tax incentives. You can't borrow money on a government-backed 30-year fixed interest term to buy stocks, nor can you claim any of the dozens of deferments, incentives, or credits that come with real estate. When it comes to reining in house prices to address affordability concerns, most people can only spend as much as they can borrow. So by restricting how much they can borrow, policymakers can easily influence home prices while also making the financial system more robust. A study on Swedish home prices found that properties become markedly more affordable after the regulators cut back on interest-only loans and introduced strict amortization schedules. A global study by the Bank of International Settlements found a similar trend across countries. If we really wanted to make homes more affordable, 15-year mortgages would do a lot more than 50-year mortgages. But that's kind of the point. Because real estate has become such an institutionalized investment vehicle, one man's affordable home is another man's crippling market crash. On one hand, 50-year mortgages are only going to make things worse by making homes even more attractive as an investment vehicle. But on the opposite side of that same coin, 50-year mortgages could help to keep a fundamentally broken market from collapsing on itself, even if only for a few extra months. Over the last 5 years, institutional investors have drawn a lot of scrutiny for quietly buying up hundreds of billions of dollars in residential real estate across the country, particularly in areas like the Sun Belt. Today, they are quietly trying to back out of those same investments because the markets they went all in on did not continue to attract the same volume of new entrances they were projecting. As I was putting this video together, Atriok did a fantastic interview with Melody Wright, one of the top housing market experts in America who has effectively been saying the same thing. Now, I will leave a link to that full interview because it's worth a watch. But to summarize, the housing market is shaking, so institutional investors with thousands of properties want to dump their holdings onto Airbnb bros with dozens of properties. But the only way they are going to be able to do that is if it becomes easier to qualify for big loans. And the only way to get those is if big loans are sold as a way to help regular people who just want to buy a single home to live in. Unfortunately, this market has become so large that they are effectively too big to fail. Actually letting homes become affordable too quickly would present a systemic risk to the entire financial system. Unfortunately, one group has to feel the pain. And it's just much easier when that group is the people who aren't yet balancing huge piles of debt and overinflated assets. Now, go and watch this video next to find out if the everything bubble can keep itself going forever. And don't forget to like and subscribe to keep on learning how money works.